Good day, students. My name is Mlungisi Hlongwane, and I'll be taking you through the last part of the series of the revision classes. I say series of revision classes because there's been classes that were recorded and they are uploaded on my UNISA, where we were looking at different case studies. We looked at about 6. Now this is the 7th case study. So the rest of the recordings are on my UNISA. Some of them, I think we had one earlier this week. It may not be up on my UNISA yet, but it will be uploaded. I also have my colleague Carmen, who will be responsible for answering your questions on the chat. So please use that question and answer section of this technology that we are using, which is the Microsoft Teams. Welcome to the new world. It's a virtual world. Let's try and embrace it. And then today we are looking at case study 9, which addresses IS-24, IFRS 3, and also IFRS 15. But before we start, let me run through few of the administration issues. The exam timetable is out, and we are all going to be writing a non-venue-based exam for the first time. But we are hopeful that the 4 written tests would have prepared you for this. Again, it's a new world, so let's embrace it. Please make sure that you sort out all your issues a day before so that you don't panic on the day. Also, make sure that you have a reliable internet and a scanner on the day, and have a backup plan just in case something goes wrong. One other thing that I wanted to mention on the admin is please be on the constant lookout for the announcements on my UNISA. Some students are still asking about the stuff that is already on my UNISA. So let's try and make it our responsibility to use the my UNISA platform. It's to your advantage. Okay, but now I want to start with this quotation by Henry Ford, which says that if you think you can do a thing or you can't do a thing, you are right. So those who make it are those who think that they'll make it and want to make it. And the opposite is also true. If you think you will not make it, then simply you won't make it. Okay. Now let's first look at the exam techniques. There are obviously two things. There are obviously things that students get wrong when preparing and also when they are writing for the exams. The first one that I want to look at is make it a habit to practice the exam, the questions under the exam condition. So let us try and make that a habit. I know we've said it a couple of times, and sometimes students think it's not possible, it's not necessary, but we know that it trains you somehow. So in other words, when preparing for the exam, do it as if you are actually writing that exam. You need to emulate the exam environment. You can't be checking on your phone while you are writing an exam. So that's just a practical example of it. And my famous line that I normally use is, you don't fail the exam on the day of the exam, but you fail the exam on your preparation, because the exam is the application of what you would have been practicing all along. So number 2, you need to carefully read the required to make sure that you only answer what was asked. Okay. Number 3, you need to plan your answer. You don't just jump to answering. You need to plan how you're going to answer. You need to plan how you're going to provide your answer, and make sure that there's a correct flow, and you position yourself you position yourself better to score the maximum marks that are available in the question. And then number 4, you must stick to the allocated time and do not run over. If during the preparation you do run over the time, please note down the time that you went over by, just to make sure that you still assess your technical knowledge sometimes. Because if you write and then you don't finish, maybe there's a question that you've not attempted, you still wanted to check if you have an understanding technically, then you can still continue writing, but then you need to record that I went over by this much. So it's important to be timing yourself as well. Number 5, I know we are not all blessed with a good handwriting, but let's try and write neatly. Let's try and leave sufficient spaces in between the words and the paragraphs. So we are actually making it easier for the markers to give us the marks. Okay, then number 6, guys, let's try and read the instructions carefully on what is expected of us. So if again we move to number 7, once you've attempted the question, give yourself some breather, then you stretch and get something to snack and maybe something to drink for 30 to 45 minutes. Like now I'm referring to when you are still practicing for the exam, not actually on the date of the exam. So you've sat down, you've spent your 3 hours, and then you've attempted the case study. After that, just give yourself some time to relax, free your mind. Then you come back and you mark yourself and be strict in your marking to try and get the to as close as possible to the answer. So you look at your answer and you say, why did I get what is on the solution? So you learn also from the solution. So I didn't mention that you use the solution to learn as well. Look at where you went wrong and ask yourself why you got it so wrong. And also it's important to also look at the stuff that you got right. So you don't just overlook the stuff that you got right, because what can happen is that you were not sure about that particular response that you provided. So now if you are confronted with another question, because you were not sure on the previous one, then you might still be doubting yourself and perhaps not produce the same response. So you need to be looking at also the stuff that you got right to just assure yourself that, okay, now this I've mastered and I understand it. Okay, so now that we'll be writing online, let's allow ourselves enough time to be able to upload the documents. So if you are told that, for example, you are given 8 hours, I'm making an example, don't be writing for 8 hours. You need to allow yourself time to be uploading, because we know that at some point there's going to be traffic and all that. So just allow yourself, plan accordingly. Okay, so now let's quickly move to the part about the journal entries. You must, as a general rule, always provide the narrations unless you are specifically told not to provide the journal entries. That's a general rule. And then for the acquisition of subsidiary, you must always provide the at acquisition elimination entry and the elimination of intercompany dividends entry. So the only time that you exclude this is when you are told to exclude it. Okay? And then the most common mistakes that the students do as well is not to provide the classification. You must specify where the entry goes to. Is it PNN, SFP, or SCE? Okay? And you must also clearly indicate which entry is a debit and which one is a credit. Okay? Lastly, on journal entries, please show your calculation or reference to the calculations. Will not mark your calculation if they are not correctly referenced. So just be careful of those things. Okay? And then under discussion questions, firstly, please make sure that you use the correct layout format. If you are required to prepare a memo, please use or lay out your question in a memo format. If it's an email, it must be an email format. Report format. Okay? If you are required to prepare your question in a report format, it must have those addressed to the dates and all those things. So you know how the report format looks like. Okay? You also need to be careful of the wording of the question and respond appropriately. Okay? The approach should be different when you are required to discuss something and when you are required to critically analyze something. So it shouldn't be the same. You need to pay attention to the verbs. Okay. Please also pay attention to when the required specifically states that you need to include the calculation in your response. Okay, well, it does not necessarily have to specify that. As a general rule, I always say include the discussions if they are applicable. But if the question specifically tells you to include the discussion, please do so. Okay? So another important consideration when answering the discussion question is to make sure that your answer is within the required scope. If the question is asking about the measurement, there's no need to discuss the definitions. You will be irrelevant and you'll be wasting time. Okay? And another one, remember to always identify the relevant theory. This is the theory that can be applicable to what is in the question. You must be guided by the issues in the question to assess which theory should you discuss. So that's the concept of the relevant theory. You don't just throw any theory that you know. Okay, so remember there are no marks for merely stating theory without applying it. So you will be bringing that theory that's irrelevant and you bring it here, but now you can't support it and you still won't get marks for those. So just be careful of that as well. Okay, so just to emphasize, marks are only awarded when the theory has been applied. Okay, so when you're answering the discussion question, you need to address the relevant factors. Okay. You do not only focus on the factors that affect or that favors your chosen sort of conclusion. So just to make an example, if a question is about joint venture, joint arrangement, you also need to discuss the factors that might be indicating that it's a joint operation, whereas your conclusion will eventually be your joint venture. So you need to be building your argument up until you make that conclusion. Okay, which leads me to another point. You need to conclude accordingly. If you've not concluded, then you've not answered the question. Okay, and then when we're looking at now the next one, which is the presentation and disclosure, you need to make sure that you know your structures for all your financial statements and your disclosure notes. If you are not sure, you need to know where to find them in your IFRS handbooks and illustrative examples. Even here, you need to make sure that you reference your answers accordingly. Okay? And now let's then look at what we're going to be covering today. Today we'll only be doing question 1 and question 2 of the case study 9. Sorry about the noise. Okay, it's the working from home. Okay. This therefore means we're looking at the identification of the related parties, the identification of performance obligation, and accounting for the right of return. So that's what we're doing today, okay? Please note that we are doing this for both level 1 and level 2. Hence, I sent that question to both the level 1 and level 2. Well, I sent it to level 1 because level 2 already had the TAT 106. So we're doing case study 9 on that one. And sorry about the miscommunication earlier on. We had said it's case study 7. It was just a typo. It was actually supposed to be case study 9. Okay. Now we will be looking at the scenario, the reading part, or okay, it's a scenario or the reading part, depending on what you call it, and then we'll look at the required and we'll also look at the solution. But we're gonna focus our time on analyzing the reading part and perhaps maybe the required. On the solution, most of the stuff would already have been identified during the reading part. On the solution, we'll just maybe be looking at how you need to lay out your answer. Okay, so let us now try and read. Okay, so what's going to happen is that I'm not going to be reading line by line because I requested that everyone reads the question. So what we will do is each and every part of the reading part, we will be analyzing to see which information were we supposed to look at here and focus on. Okay, so when we look at that first slide, that slide is about the background information, and we are not really interested in the background information for now. Okay, so it's just telling us about who Mintel is and just the background information about the industry. But then now the second slide provides more information about the shareholders of Mintel. Okay, The question specified, or the reading part specified, that this is only those shareholders which have the significant shareholding. So that is why, like, some people might ask, if you look at that information and the shareholder information, it would add up to 82. It's 82.1%. So that's because it's not every shareholder that's there, but it's those that are considered to be significant, which is 55% and more. Okay. So this is now analyzing the information. Okay. That table has a name of a shareholder, the percentage of ownership, the description of the type of entity, and also the reference to the notes, which is important. Okay. So what we can observe here is that the Davids Family Trust is a majority shareholder with 27.2%. Okay, that's now us analyzing the information before we even look at the additional notes. Okay, but we can also conclude on the type of investment that Mintel is to the Davids Family Trust. That is in absence of any other information, because now it's more than 20%. Here, there's that presumption about the significant influence. If you own more 20% or more, then there's that presumption. But that's now before we look at any other information. And that's the same thing with the Uguchuma Trust. Okay, so we will have to look at the notes to get more information. Okay. The other observable factors here is that the community trust, we need to consider that generally such trusts are normally set up by the companies to administer their employee share schemes, as it's written there, PE community trust. But we're just going to find out more information as we continue. Okay. And then there's another company, which is an investment company. Again, we don't have much information. We'll need to wait for the notes. Okay, and then we are told about the retirement fund. Okay, remember the definition of the related party also includes the post-employment benefits for the benefit of the reporting entity's employees. So that's just something that we have at the back of our mind. We just have to find out this Mintel retirement fund, who is it for? Is it for the benefit of the employees of Mintel or someone else? Okay. So then now we also have Mr. Alberto Frum. Okay, what we need to remember here is that an individual can only be related to the reporting entity if that person or the close family member has control, joint control, or have the significant influence of the reporting entity, in this case Mintel. But we'll just wait and see the information on the notes. Okay. Now, if we move to slide 11, it provides more information about what was laid out in slide 10. Okay. We see that the founder of the Davids Family Trust is Mr. Davids. Okay. He's a CEO. And when someone is a CEO, then they're a member of the key management personnel. Okay. So we can already associate Mr. Joshua Davids himself to Mintel. Okay, but what was shown there was the trust, which is the shareholder to Mintel. So we need to say now, is there a relationship between the trust and Mintel? Okay, but let's just take that information for now, and then what we see is that there is, by the virtue of his trust owning more than 20% of the shares in Mintel, we can already assume that the trust has the significant influence in Mintel and therefore is related to Mintel. Okay, but remember the definition here on the related party. It does not really talk about the significant influence. It talks about having, it talks about the relationship being an associate. So you must remember, even when you are answering this type of questions, to say, you first have to say, yes, they've got the significant influence, but then they also, then you conclude to say, therefore, they are an associate, before you can then say they are related parties. So I'm expecting to see those three things. Significant influence, therefore an ASOC, therefore related party. Okay, so now with the PE trust, the majority of the voting rights are controlled by the community representatives. Okay, that's the voting rights. But then we see here that Mintel directs the relevant activities of the trust through a contractual arrangement. So what does that mean? It means that Mintel controls the trust, even though Mintel does not have the majority of the voting rights. Okay, and then we can already tell from this information that this is a structured entity. Why? It's because the voting rights are not a factor when determining who controls the entity. So such entities are called structured entities. Okay, so that's the information that we get as we are analyzing the question. Okay, then the presumption here is also not applicable, as the information explicitly says that the trust does not exercise significant influence in Mintel. Okay, then there is another party here, or another shareholder, which is the Alan Ford, which is the investment company. We are told that they have an active participation in the policy making processes. So what does this mean? It means that they are able to influence the policies of Mintel, and therefore they have the significant influence. When they have the significant influence, it means therefore they are, and Mintel is an ASOC. Therefore, Alan Ford is related to Mintel. Okay. Now, the information in the question indicates that the retirement fund is a defined contribution plan for Mintel's permanent employees. Remember, that's the question that we had from the previous slide to say, but for whose benefit is this defined contribution plan? Then we realize now it's for Mintel's permanent employees. So we know that in terms of S24 paragraph 9, subparagraph B, Roman figure 4, then the retirement fund or the defined contribution plan is also a related party to the entity if it's for the benefit of the employees of that entity. Okay, so we can conclude that Mintel, I mean the defined contribution plan is the related party to Mintel. And then lastly, there's Mr. Froome. We see that Mr. Froome only owns 5%. It means that there is no control, there's no joint control, and there's also no significant influence, or there's no associate relationship that exists. And there's no information that suggests that maybe the close family member of Mr. Froome has one of these things that I just mentioned. He also is not a key member of the management personnel. So therefore, Mr. Froome is not a related party. Okay. So just a quick recap on the exam technique. I only identified what was the relevant theory, if you noticed. Okay. So within IS-24 paragraph 9, I've selected what was only applicable to the scenario, not everything. Okay. So there's no need for me to be making references to joint control, for example, or other entities who are the members of the group, because it's not applicable to this particular information that is on the question. Okay, so that's how we analyze the information. And then now, if we look at the investment in Telio Limited, we need to be always careful about the dates, which is the date of acquisition, the date of disposals, and year ends. So that comes in handy when you have to be doing the calculation and also deciding what happened on what date. Okay, so here there was an acquisition of 50% of the shares for 1.2 million. Okay, that's all we know for now. Okay, we were also told that the 1.2 million included the acquisition related cost of 75,000. Okay, here, because we do not yet know that this is an acquisition of a sub, or an acquisition of an ASOC, or an acquisition of a joint arrangement. So if we don't yet know, we do not know how we will then classify the acquisition-related cost. Because remember, in the case of a joint venture, then you need to be adding the acquisition-related cost into the cost of acquiring the joint venture. Okay, but then the question further talks about this being correctly classified as a joint operation. Okay, so if it's a joint operation, there is a way in which you have to account for. There's a way in which you have to account for that particular investment, and it draws the principles of IFRS 3. I know that we spoke about the accounting for the joint operation as not being part of the scope, but this is now for your own understanding to say it draws some of the principles of IFRS 3, okay, which we're going to deal with now. Okay, so according to the IFRS 3, we know that you have to exclude the transactions cost. The transactions cost, they must be expensed in the books of the acquirer, so they do not form part of the consideration that is transferred. Okay, so it is also important to note the classification of the joint arrangement. As I mentioned, we are told it was a joint operation. Now, as a student for FAC 4862, 4864, who's been studying this type of investment, now you think about IFRS 11, paragraph 20 to paragraph 23, and also paragraph B33A on how you need to account for these joint operations. Okay, so here, an important thing here to ask is whether this constitutes a business or not. So we know that there's been a change or an introduction of other aspects that we need to consider when deciding whether something constitutes a business or not. Okay, we're not going to be dealing with that today. Okay, so let's say now you conclude that this constitutes a business. You need to follow the business combination principle, but only to the extent of their share. So it means now Mintel, as they are acquiring this 50%, they follow the principles of business combination, adding their portion only now. It's no longer going to be 100%, but it's only their portion of the assets and liabilities, income and expenses in their separate books to account for the joint operation. Okay, so again, let me emphasize the point that once told that you have a joint operation, you do not have to discuss the classification. So the question cannot now ask you whether this would be a joint operation or not, because you've already been told. Okay? So what we know about the joint operations is that the parties will recognize their portion of jointly held assets and liabilities, jointly held. So I'm emphasizing that for a reason, because there could be assets that do not form part of what is jointly held. So we need to be careful about those things as well. Okay. Another thing that they share is the revenues and expenses according to their percentage. Remember, it will not always be 50% like it is in this case. Some might have 40 and the other party has the 60, or could even be more than two parties. So they just have to always remember that it's only your portion. Okay. So now, on slide 13, it provides more information on the assets, the liabilities, the income, and the expenses. Okay. So here, what we can already see again is the office building, which is not part of the jointly held assets and liabilities, as the question says that it's retained by the other party, which is Cromin. Okay, the income and expenses of Telio will be shared jointly. Okay, that's very important. So they will be sharing those income and expenses. So since Mintel have ownership of the machine, this machine will also not form part of the jointly held assets. Okay, I'm going to try to move quicker on this one, as I mentioned that it's just for you to have a better understanding of how will this be accounted for. Okay. The revenues that are generated, however, on this asset that I say it's for Mintel, those revenues would still be shared between the parties. It's only the asset that will not form part of the jointly held assets. Okay, so the parties will have to share the 50-50 on the assets and liabilities, but that is only applicable to the assets and liabilities, again, that are held jointly. Okay, so now let's look at then the trial balance that gives us the list of assets and liabilities of Telio. On the slide, we see that there are references to the additional notes on the list of assets that are provided. So it's very important, again, to say you cannot make any conclusion at this stage until you've read all those references or all those notes that they're talking about here. Okay, so now let's look at the notes. Okay, interestingly, note 1 and 2 is the emphasis on the information that was provided in slide 13 about the ownership of the admin building and the machinery, one being owned by Cromin, the other one being owned by Mintel. Okay, so what is more interesting also is on notes 3 and 4. Okay, why? Note 3 indicates the fair value of the PPE, which is actually less than the carrying amount that was shown on the trial balance. Okay, so what does that mean? It means that we have to adjust it because the principle, we said it borrows the principles of IFRS 3. The principles of IFRS 3 tells you that at acquisition, you need to be measuring your net assets at fair value. Okay, so now that is why you have to drop the the carrying amount of 2,250 to the 2.1 that you are told about here. Okay, so again, remember, you always have to take into account the deferred tax consequences. You don't forget that. Okay, so now note 4, it relates to the internally generated intangible asset, which is a patent. Okay, remember IFRS 3 says we need to take into account the fair value of the assets at the date of acquisition and not the carrying amount or not the cost. So here, therefore, we will look at what was the fair value at acquisition. It would be 950. So that's the amount that we're going to use for this internally generated intangible asset. And remember, we ask ourselves before, it's not automatic that we will have to include it, but we need to look at the separate, does it pass the separability criteria? And here we are told that the patent was licensed. So if it was licensed, then it means that we can be able to identify it. Okay. The inventory, cash, and trade payables, those they had the fair values that equaled their carrying amount. So therefore, there was no need for an adjustment. Okay. There was also no movement in the share capital during the year. Also, we were given the applicable tax rates if we look if we move to the next slide. Okay. There was also no need to eliminate any intercompany dividends here because there were no dividends that were declared or paid during the year. Okay, so that's just how we've analyzed this part of the question. Maybe what I needed to have indicated also earlier is that we will be doing only question 1 and question 3. Question 2 we will not do because it was covered in other questions that were dealt with, which I said you will need to go to my UNISA and you will find the recordings there. Okay, now let's move on to the question 3, which I think it's interesting. It's my favorite one. It's a revenue. Okay, it's very important to note that the information can be presented in various forms. Okay, so here it was presented in the form of an email. Okay, so that shouldn't now throw you off to say, I'm not used to this kind of format. So when now they're saying there's query 1, query 2, maybe you just used to having a table or trial balance or the financial statements. Just be comfortable with the fact that the information might be presented in a different format, and that's part of the exam technique. Okay, so now let's look at the first query that they provided us with here. Okay, so the entity entered into a contract with a customer for the sale of the machine. Okay, so if you enter into a contract, then we're thinking now IFRS 15, because that's now the standard that governs the recognition of revenue between the contract with the customer. Okay, so the contract included a warranty component. So that's what we've learned from this question. So now we need to satisfy ourselves that the contract was entered into was in terms of IFRS 15, paragraph 9. Remember, that is also important. Most questions will specify that you can assume that this constituted a contract in terms of paragraph 9. Okay, so it needs to meet all those criteria in terms of paragraph 9, but we'll just have to find out. If the question doesn't specify that, then we cannot just automatically assume that it was in terms of paragraph 9 of IFRS 15, because the question could still be asking you, is this a contract in terms of? So now you have to be looking at all those factors that we consider, whether we've got the contract or not. Okay. So now, the step about identifying the contract is the first step in terms of the revenue recognition criteria. Okay, so remember the 5 steps. So this one is the first step. Okay, this is now before we can move into step 2, which talks about the identification of the performance obligation. Okay, so what we can see here is that, because now they're talking about the warranty, it means there are 2 promises in this contract: the sale of the machine and also the warranty. So now the biggest question would therefore be, okay, do these 2 promises that are in this contract constitute what we call separate performance obligations or not? So that's the biggest question now that we have, because we've got this one single contract, but then there are 2 promises. So we need to find out whether these promises are actually separate performance obligations. Okay, we know there's a criteria that we have to look at now in terms of IFRS 15. Okay, what was also interesting here for me was that we were told that the warranty assures that the customer that the machine complies with the agreed upon specification. Okay, so what does it give an indication to? It gives an indication that the warranty does not provide an additional service, you know, in terms of what, I mean, in addition to what, to agreeing, to making sure that the machine agrees to or complies with the agreed upon specification. Okay, so that for me is another interesting factor. If we are told that it just has to make sure that it functions as it was intended to function, so it means that there's nothing in addition to that this warranty is providing. Okay, so another important factor again is to consider whether the warranty can be purchased by the customer separately. Okay, the information in the question does talk about that, does say that the customer A does not have the option to purchase the warranty separately. Okay, so what does that trigger? It triggers IFRS 15 paragraph B28, which says that if a customer does not have the option to purchase a warranty separately, an entity shall account for that warranty in accordance with IS 37. Okay, so it means it's not a separate performance obligation. This is how they need to be dealing with it. It needs to be recognized as a provision. But then it says that unless that warranty provides the customer with a service in addition to the assurance that it complies with the agreed upon specification. In this case, it would be applicable because the question specified that the warranty does not provide an additional service. Therefore, it would be accounted for in terms of IS 37. Okay, but then now, if that was not the case, if the warranty was actually the customer had an option to purchase the warranty, it would have triggered paragraph B30, which then says if a customer has the option to purchase the warranty separately, the warranty is a distinct service because the entity promises to provide the additional service to the customer. So you see now the implications, it differs. So the minute you know that it does not have, then you know that it needs to be treated in terms of IS 37. But if there's more information that suggests that it provides an additional service, in addition to just making sure that it complies with the agreed upon specification, then that's where now you have to look at other factors, okay, which I'll briefly talk about. Okay, so if we're looking at the slide, that we realize that there is an additional promise in this contract. It talks about the training service. Earlier on, we were looking at only the selling of the machine and also the warranty. But now we realize now when we look at, no, it's actually slide 19, sorry. It talks about the training. So it means when you enter into this contract to buy the machine, 3 things. They promise you to sell you a machine, they promise you that you're going to be trained, and they also promise you that warranty. So it's an additional promise, which we need also to assess whether it will constitute an additional, a separate performance obligation in terms of step 2 now of the revenue recognition criterion. Okay, so what it says is that these training services, they're actually provided at no fee. Okay, it is also very interesting to note that the entity is able to sell these machines without a training service. Okay, so they also provide the training services separately, meaning the customer who would have bought the machine elsewhere can actually be able to buy the training services from this company, okay, which is Plaster. So when we're assessing whether the promises are distinct, which is part of the assessment of the separate performance application, we have to consider that. We have to consider whether are they able to sell it independently of the machine. Okay. For example, when assessing whether the customer can be able to benefit from the machine or the training services on their own, those are the things that we have to look at. We have to look at the fact that can it be sold at separately, like using or have the price attached to it, which is a standalone selling price, could be an indication. Okay, so now that you've been entrusted with this task, which the question says, of helping management to identify the separate performance obligation in the contract, you need to be thinking about all these factors. You know that you've identified IFRS 15, and you have to be focusing on step 2, which is the identification of the performance obligation. Okay, that's where again we're speaking about the relevance. Okay, so here specifically they wanted you to help them with the training and the warranty service, to tell them whether they're separate performance obligations or not. So that's just the summary. So they're not saying anything about the machine. I know that we've not come to the required part yet, but from the email that we're getting, that's what is their worry. If you read this one carefully, it says Plaster requires our assistance to identify whether the training service and the warranty in the contract with the customer are separate performance obligation in accordance with IFRS 15. So you see, specifically, they tell you that this is what is relevant. Anything outside this is not relevant. So that's where your focus should be. Then now we've got query 2. Okay, this part of the question provides the background information, which was also not that important. Just tells you it's an e-commerce retailer, so it's just the background information in the industry. Okay, it tells you about the shoes that they're manufacturing. Okay, so if now we move to this slide, this part now of the question deals with the right of return, which then triggers for me paragraph B21 until paragraph B25 of IFRS 15. So then again, we're talking about the relevance, because IFRS 15 is such a big standard. You can't be quoting everything in IFRS 15, but you've got to be looking at what is relevant based on the information that is in the question. Okay, so Take More allow their customers to return their unused shoes within 15 days, and then they refund it. So what happens there is that there's a promise to say, if you come and buy, we're going to give you the shoes. That's the first promise. Then number two, then we're promising that we're going to refund you your money. Okay, so those are the things that they're doing. Okay, already for me now, it triggers the fact that now there is a variability in terms of their pricing, because within 15 days, they can't fully recognize that revenue because someone might come and return their shoes. So they have to be careful in terms of how they're dealing with their revenue. So now it touches on the transaction price. Okay, so the determination of the transaction price now is affected. So we dealt with the contract part. Number two, we dealt with the identification. And then now in this particular question, it focuses on now the transaction. What should be the transaction price? That should be recognized. Okay, so now there's that variability, because now we need to be making those estimates about how much can we reliably say that it's not going to be refunded to our customers. Okay, so it's also important to note that the refund is only applicable when the shoes are returned due to the change of mind, and not because of the defects that we identified. Okay, so it's important, because if the information in the question says we're expecting that 15 customers will return the shoes, but 12 of those are returning the shoes because the shoes have defects. So then you would understand, you need to understand that the refund is not applicable to the shoes that have defaults, but it's about when a customer decides to change their mind. So it's very important to be looking at those details. I normally say in accounting, the devil is mostly on the details, so you need to be reading with that respect. Okay, so the question goes on further to provide the exact quantities now of the, if we look at this slide now, they talk about the exact quantities of the affected shoes and the relevant dates. I spoke about dates earlier on. I said they're very important because you need to understand what happened when, and therefore the accounting is also affected. Okay, so if we look at the information that's presented to us, so we see that between 1 February until 29 February, 62 pairs of shoes were sold. Okay, but can we recognize revenue immediately for these shoes? We don't know. We need to get more information on the question in terms of what happened and what were the expectations. Okay, so there was an issue with the accounting for the right of returns attached to the sold shoes. Okay, so when you read that information, that's what you get. So we're also told that none of these 62 shoes were actually returned by the end of Feb. So what does that mean? Does the fact that there were none of the shoes were returned, does that mean that we can recognize the revenue fully? Probably not, because the 15 days that's there is we by the end of Feb, because it says, if you go back to that, it says the customers returning. Let me start. On the 2nd of January 2016, Take More decided to allow customers to return Italian leather shoes within 15 days from purchasing the shoes on TakeMore.com website. Customers returned their unused shoes in its customers returning their unused shoes in its original packaging within 15 days from the date of purchase will receive the full refund. So what it means is that if this now lapses, then you have a right to actually recognize the revenue, because you no longer have that promise, you no longer have that obligation. So that's the parts that I wanted to address. Okay, so there was, if you look at that information again, you see that I think it was yes, the second last line. It says that there was an estimate of 6 pairs that would be returned in March for a full refund. So what does that mean? It means that we're creating an expectation to say, okay, these shoes would be returned. So is it then fair to recognize the full amount? It's not, because remember, again, in the principle of IFRS 15 and revenue recognition, it says that you recognize the revenue only to the extent that you will be able to actually collect the amount. Okay, that's actually the definition of the transaction price. It's the amount that you're expecting that you will be receiving. Okay, so what does that mean? It means this needs to be accounted for as a provision or a refund liability. Okay, so it means the 62 pairs of shoes and the 6. So 62 minus 6, it would be 55. Then the 55, you can fully recognize the revenue, but then for the rest, you'll have to recognize the refund liability. Okay. When we move on to the next slide, we see that we were given the price per share, which is 950, and that is the price that we're going to use to determine it's going to be our transaction price. But that transaction price, remember, it needs to be, because it's variable, then we need to adjust for the expectation that some of these shoes would actually be returned. Okay, so if you think about it, the 950 times 62 should have been the sales amount had there been no expectations of returns. That's what we would have done. But now, because of the returns, it's only 53,200, which is based on the 55 pairs, which will be recognized as the revenue. Then the 5,700 for the 6 pairs will be accounted for as a refund liability, like I mentioned. Okay. Now, remember, when there's a sale of inventory, there must be another leg of the journal entry that affects the cost of sale. Okay. The cost of each pair, we are told that it's 500. And therefore, the cost of sales that should have been recognized for the 62 pairs of shoes should have been based on 500 times 62. Okay. However, we have to take into account the expected returns of the 6 pairs. Okay. Now, to account for this, we'll have to raise a right of return to the amount of 3,000, which then is 6 times the 500. So we need to create that right of return. So we do not recognize the full cost of sale, but then the part of that cost of sale will go to what we call the right of return, because that could still be returned. Okay. So another interesting thing that was mentioned here, if you look at that first paragraph, it says the cost of collecting the returned shoes from the customer is deemed to be immaterial. Okay, so if these costs were not immaterial, they would have been taken into account when we are recognizing the right of return. We would have said 500 less the cost of collecting those, but now we are told that it's immaterial, therefore it would be 0. Okay, so remember, revenue will only be recognized when the performance obligations have been met. So that's the second part now that's the second paragraph, because it tells you that it happens on delivery. Okay, so the shoes were delivered by the 29th February. What does that mean? It means that that's when the control passed to the customer, and that's when the performance obligation was satisfied. Again, the implication is that that's when you start recognizing the revenue. Okay, so it's at that date. If it's the 29th of Feb and we're expecting that something will happen in March, so we're expecting that 15 days, something will happen within the 15 days from the 29th of Feb, which that 15 days falls into March. We need to take into account those expectations, which was the 6 pairs in this case. So that's what we need to always remember. So we do not recognize the full revenue for the 62 pairs, but we only recognize for the 55. And then the 6 will recognize the refund liability. And if it happens that it expires now, this refund liability, no one returned the shoes, then you have the right from that date to then fully recognize the remaining 6 as a revenue. Just always remember that. Okay. So from analyzing all this information, then we are better prepared to deal with what could be required. Okay. So, and I always emphasize the point that when you read so that when you now have read your required, you only come back to take the information so that you are able to apply it to the theory, or yes, to the theory that you have identified. You don't have to be coming back and rereading again. So your reading, take your time in reading, understand, and then make sure that you make those highlights and everything, so that when you come back, you don't have to be rereading stuff, but you're just going straight to the information that you need. Okay, so it's very important. You would have seen that I took time in terms of analyzing the scenario. Now let's look at the required. Okay, again, this is the most important thing. You might have read your scenario and you fully understood your scenario and everything, but then if you have not read, you can't jump from the scenario to attempting, because you don't know what's asked. Okay, so this question actually had 2 parts. Okay, if we look at question 1, it had 2 parts. Therefore, you have to make sure that you've answered both. So if you've not answered both part A and part B, then you are not done with this question, and you are increasing your chances of not passing. Okay, so please make sure that if it's 2, like, put in your mind that it consists of 2 parts. So don't spend too much time on the first part, such that you don't end up you end up not being able to answer the second part. Okay, so you have to read the entire required, and you have to do it slowly and make sure that you understand what is required of you. Then you will have to decide which one are you going to start with and which one will be the next up until the end. Don't just decide on which one you're going to start with, but decide on, this one's going to be my first, this one's going to be my second, up until all the questions. Okay, so that will help you in terms of your order of answering, and obviously there you factor in which one do I understand better, which one am I sure that if I go here I'm going to score the marks, because you don't want to start with something that will frustrate you and then it puts you out of the mood for even the other question. So just be strategic in terms of how you plan on answering. Okay, so don't jump to answering. Plan, take your time. I normally say read and reread the required, and then plan accordingly. Plan your execution as well. This is how I'm going to execute my answer. Okay, and I think now it's nice. There's not going to be pressure because you are studying from home. If you were, you're writing from home. If you're writing in the exam hall, that's where you start, a lot of people writing. Then now you get tempted to start writing without even strategizing. So please just make sure that you strategize. Okay, so here you are required to discuss with reasons whether the identified shareholders are the related parties to Mintel. Okay, now you have already identified those shareholders because you were given that table. So you know that I'm only focusing on the shareholders. What does that mean? It means that I'm not going to be discussing Mr. David as an individual, but I'm discussing the trust. So I must be looking at the trust, whether the trust is a related party to Mintel or not Mr. David. Okay? Maybe you can build an argument from saying Mr. David is related to a trust, therefore the trust is, let's say you prove that Mr. David as a key management member is related to Mintel, and then you talk about if maybe he controls the trust or he owns the trust, then you can make that kind of a link. But it's not required for you to be discussing Mr. David at this point. Okay, so now your discussion should be with reference to your relevant theory, as I discussed that earlier. So as I was going through the discussion, or as I was going through the reading part, I was actually pointing out also the paragraphs that are applicable. So it's also another important aspect to say, when you discuss, it must be in context with your theory. So you need to identify those relevant theories. You don't have to write down the theory because you will not get the marks for stating the theory, but you have to make sure that you apply whatever theory. So to apply it, you need to have identified it. So again, let me define what I call relevant theory. Relevant theory is the theory that can be supported by what is on the information in the question. So if it cannot be supported by what is on the information in the question, then it's probably not relevant, okay? Because how are you going to apply the information in the question, okay? So remember, you must always conclude. They're asking you here, are these shareholders related parties? So at the end of the day, I'm expecting you to say, therefore, is a related party, no, or therefore, they're not related parties. Okay, so it's very important. Okay, now note how this question is sort of phrased. It does not say identify related parties. So what does that mean? It means you have to discuss all those shareholders and then conclude whether they're related or not, okay? You do not have to discuss only those that are related parties. So if it says identify related parties, if the question says identify related parties, then it means you're only going to talk about those that are related parties. But if it says discuss whether these people are related parties, it's something else, okay? Just remember again that with IS-24, you could be asked about the related party disclosures. You need to be looking at IS-24 and know exactly what you need to disclose. And you can also be looking at your illustrative examples just to see how it should be disclosed, okay? So now if we move to part B, here you are required to discuss how the investment in Telio should be recognized or accounted for in the Mintel's books. I did mention that this is an investment in joint operation, which is something that we said we're focusing only on classification, but it's still worth understanding it. Okay, here you are required to discuss how they should account for it. Remember, we've identified that this is an investment in joint operation, and we've also identified that it must be accounted for in terms of IFRS 11, paragraph 20. So that's where now the issue of relevant theory comes in, okay? So again, pay attention to that one mark. It could be a difference. There's a mark that's allocated there for communication and logical flow. So you just have to make sure that you do not miss out on those easy marks. You know, please make sure that there's a flow in your argument and there's proper conclusion flowing from your argument, okay? But then I also want to bring to your attention this. You see there's a please note there. It's just below the communication and logical flow skills. And that is now to guide you further on how you are expected to respond. Here you were asked, for example, not to include the discussion on the disclosures and also to include the calculations in your discussion where applicable. So you see now, this is now the further guidance, because what could have happened is that you identify whether something is whether the shareholder is a related party or not. Then you go on further to talk about how they should be disclosed, okay? And then also when you're looking at the investment in joint operation, you could say this is how they need to account for it, and this is how they need to be disclosing it. So you see now, this helps you to prevent you from going further and wasting time and not getting marks for those, okay? So, and then they're showing your calculations. I think that's basic. I always say it's a general rule. Make sure that you show your calculations. If you've used calculations somewhere, show the calculations, okay? Then now let's look at required question 3. First line that says prepare a memorandum to the senior manager, wherein you, okay. So once it says prepare a memorandum, I'm expecting to see a memo format. Lay out the question in a memo format. Anything outside that, then it means that you're probably going to lose the marks that are allocated to the layout. Okay, so you do not want to put yourself in that position. So if we look at part A now, you are required to discuss whether the training services and warranty constituted the separate performance obligation. Luckily, it confirms what we were anticipating. Okay, so here you needed to discuss only step 2 of the revenue recognition criteria. And you had to focus on the 2 promises that were identified, the training and the warranty, nothing else. Okay. So we've already identified that the relevant paragraphs in IFRS 15 would be the paragraph that firstly that introduces step 2, which is paragraph 22, and also we will look at paragraph 27, which then talks about distinct. Okay. So now, once we've identified those paragraphs or that relevant theory, then we have to make it applicable to the scenario. So how do we make it applicable to the scenario? It's all those factors that we would have been identifying to say, oh, okay, it could be sold separately. It can be sold separately. It does not provide an additional service. In addition to just ensuring that the machine operates as it was intended or as per the agreed upon specification. So those are the factors that you would have been identifying as you're reading. So now you are making this relevant theory applicable to those factors in the scenario. Okay, so and it says that with reference to query 1, and that's where we know it happened. Okay, then there's the communication and logical flow again. Just make sure that there is a flow in your answer. You start, you introduce your argument, then you argue, and then you make those conclusions. So then you get those marks. Now, on to part B. Here you needed to discuss the accounting treatment of the right of return of the shoes for the year ended 29 February 2016. Again, we've already identified the relevant paragraphs in IFRS 15, talk about B23, talk about B25, okay? So again, you then now use the information that is in the scenario to make it applicable to that. So in other words, you would realize that my emphasis is on identify the theory, make it applicable, then you conclude, okay? So there's no other way in which you can argue without using your IFRS handbooks. Okay. You also told to assume that the sale of the shoes constituted a contract in terms of IFRS 15, and that it was a single performance obligation. Okay. So what it does indicate is that we now have to focus on the accounting, and the accounting for it says that we have to ignore part 2, step 2, step 1, but now we are focusing on from step 3 up until step 5. So step 3 is the determination of the transaction price, and then talk about the satisfaction of the performance application, and then the recognition of the revenue. So those are the relevant paragraphs that we're going to be looking at. Okay, so the required, it further guided you now in terms of, again, you needed to include your calculation in your discussion, and you were told avoid the presentation. You don't have to talk about the presentation. Okay, so again, I spoke about the calculations to say it's a general rule. Whenever you have to use the calculation, you always have to include the calculation, whether told or not. Okay, so that's also how you would have analyzed this required. Now, I did say that we're gonna look at the solution, but we're not going to be spending much time on the solution because most of the issues, we identified them during the reading part. Okay, remember guys, if you've got those questions, please be typing them on the Q&A, and then Carmen will be very much interested and willing to assist you on that. Okay, so on the solution, So I'm just going to be illustrating again how your answer should be laid out. So what happened here is that they first provided the definition. You do not have to provide the definition because you're not getting marks for it. So what happens is that you identify, this is now the identification part. So I've identified that the person can be a related party if this is the case. So that now sets the tone for all your discussions, okay? Then we start with the David's Family Trust, okay? So when you look at the David Family Trust, it first talks about that it has the significant influence, okay? How did we conclude that it has a significant influence? It's because of that presumption in terms of IS 28 paragraph 5. It's not 38, it's 28, so that's a typo. So it's 28 paragraph 5. It says that if you've got more than 20%, and that's what I alluded to earlier on, to say you can make that presumption unless there's some information that then says no, but because of 1, 2, and 3, therefore they're not, and as they do not have significant influence. So says that Mintel is therefore an associate. Remember, I spoke about you first argue, then you say it's therefore they therefore have a significant influence, therefore they're an associate. And if they're an associate, therefore they are a related party. So that's what you do. Okay. Then we move on to the next shareholder, which is Uguchuma Trust. Okay. The Uguchuma Trust, we did identify during our reading time that Uguchuma Trust is actually controlled by Mintel through the contractual arrangement. It's a structured entity because the relevant activities are directed through other means than the voting rights. So that's now a structured entity. Okay. So if Mintel now has a control over this trust, it means the trust is a subsidiary of Mintel, therefore a related party. Okay. So remember, so it talks about an associate, talks about control or joint control. So once you've concluded on any of those three, to say, okay, there's joint control, and then it's an associate, therefore it's a related party. Then we move to the investment company now, okay? If we look at this investment company, they hold less than 20%. That's the reality. But does that exclude you from ever exercising significant influence? No. So it simply means that it's not based on the percentage, because they did mention that they actively participate in the policy making, which we did identify during our reading time, to say, therefore, these ones have the significant influence. Therefore, they're an ASOC, and therefore, they're a related party. So that's how we're looking at this. Then when we look at the retirement fund, again, during our reading time, we identified that, okay, this is a post-employment benefit plan, okay? It's for the benefit of the employees of Mintel. Therefore, this fund, in terms of S24, paragraph 9, subparagraph B, and then Roman figure 5, then they are a related party, because that's specifically coming out of that standard. Okay. Then now, if we look at Mr. Alberto Froome, this guy, we did mention that he's not a significant shareholder that maybe has a joint control, that has a significant influence, or that has control. So, and also we are not told about any of his family members, close family members, who have what I've indicated, and it's also not a member of the key management personnel. Therefore, there's nothing that is actually tying this guy to be a related party. Then you conclude, then the guy is not a related party. Okay, so here it's just on exam technique again to say, remember to provide the relevant theory, then apply to the question. You can't have just the relevant theory and not apply. And for you to be able to apply, you need the relevant theory. I'll make an example. An example would be to say, if you just apply, some people say Mr. Alberto Froome owns 5%. Mr. Alberto Froome, okay, let me just think about, okay, let's look at the one where it's actually a related party. Okay, if we go back and look at, for example, Alan Ford Limited, okay, it says that they hold less than, maybe not hold less than 10%, 20%. They would actually talk about the information that is in the question, and they'll say they own, if we can just quickly go up, I can't remember what was the exact percentage of this guy, but okay. So they will say Alan Ford, then they own 18.4%. They're an investment company. Alan Ford actively participates in the policy-making processes of Mintel. Then they conclude and they say it's a related party. You've not really applied anything there. You've given us the information in the question. So that's not application. So the application is when we can see that you've actually identified the theory and you're speaking about the significant influence and you are linking it to the information in the question. We do get those kind of requests for remarks, and students are saying, but I can see this on the solution. But how it's actually applied, they're not noticing that it's actually creating a link between what is in the question and also what is in the standard. So that's just what I wanted to emphasize there. Okay. You can also look at the screencast that we posted there on my UNISA, specifically for IS-24. And also what I wanted to bring to your attention again is that the required stated that only the identified shareholders should be discussed. Okay, that is why there were no marks that were actually allocated to Mr. Davids, because he's not a shareholder. The question specifically said the shareholders. Okay, so now again, when we have to move to part B of this question, which was talking about the investment in joint operation, I'm just going to quickly highlight again the fact that there is a link here between the theory and the application. So you do not have to be stating the theory. You just have to identify the theory and apply it. So I'm happy with someone that starts from apply, and then that's what we need, because that's where the marks are allocated. If you can see under the part that says theory, there's no mark allocation. So you need to make sure that you apply. So again, it's those principles that I mentioned to say it borrows the principles of IFRS 3, but then it's only applicable to their respective percentages. If you look at that, there's a 50% to assets and liabilities, and then there's 0% in respect of the office building, because the office building belonged to Cromin, so it was not jointly held. So that's just to further emphasize on that. And then again here, it's the same process. They identify theory, and you see there are no marks allocated to theory, but the marks are only on the application. Okay, so the theory talks about identification of the business. Is it a business? Then there's an application there to say this is a business. And this now, it was before we take into account those concentration tests and whatnot, which I said we're not going to discuss for the purpose of this question. Okay, so, and then here, it now talks about the actual measurement at acquisition. So it's the theory that's being introduced as well. And then now it's the application. So theory, application, you just have to make sure. Here it talks about, it brings in the intangible asset, which was the patent that was never recognized before, but now because it borrows the IFRS 3 principles, then it has to be recognized for the first time. Okay, and then it shows you how you then eventually get to your goodwill. Okay, yes, that's the part now that talks about the goodwill. So again, if generally if the question doesn't confine you to a specific standard, it would be taking into account that various other standards would be applicable. For example, we spoke about IFRS 3, but we're actually dealing with an IFRS 11 item. So we know that it would actually require you to borrow from IFRS 3, the principles of IFRS 3. So that is why the required did not specifically say in terms of IFRS 11. Okay, so now on the interesting part that I spoke about, which is question 3, see, it's in the memo format. So this is what we're expecting to see from a student. Okay, then if we focus now on part A of the question, talks about the identification and the discussion of whether they are separate performance obligation. You do not have to write that heading. It's just from our side to make it easier for you. Okay, so I spoke about the relevant theory, which is IFRS 15, paragraph 22, and then the paragraph 27. So the paragraph 22 is where now it's introducing to say, for it to be a separate performance obligation, this is what we look at. And then one of the things that I mentioned there, it's the distinct in paragraph 22. Then paragraph 27 further explains to say, but for it to be distinct, what should it mean? So that is when now it talks about the ability to benefit the customer on its own, and then the separately identifiability criteria. Okay. So again, you're just not talking about, you're not listing the theory, but you're making it applicable. Okay. So the assessment here, they're talking about the training services. Remember, I said we must focus on the two promises. We're not talking about the machine. We're talking about the training. We're talking about the warranty. Okay. So if we look at the training services now, can it benefit the customer on its own? It actually can, because it can. They're in the business of selling the training services, like I mentioned. So that part is now met. Okay. So how I expect a student to actually present this answer is to first discuss the fact that it must be distinct. Firstly, that's one, it must be distinct. But for it to be distinct, it must benefit the customer on its own. So then you discuss that, then you conclude on that. And then you move on to the separately identifiable criteria, okay? And then we know under separately identifiable criteria, we have to look at the three things, which is the integration, the customization or modification, and then also the interdependence or interrelatedness. So those are the three that needs to be discussed every time when you are faced with a question that wants you to discuss whether it should be a separate performance obligation or not. Okay. So what happened here is that they're now looking at the training service to say, okay, when we're looking at integration, is it integrated or is it part of this package of the machine? Is that how they just sell the machine? No, we realize that no, you can't actually sell a machine without the training services. So that means that first criteria is not met. Okay, and then the second one is to say, okay, can it customize? Can it modify the machine? Because we realize that there's no relationship between the two. Okay. Then number three, it talks about, is it dependent now? Does it depend? Can it function without the machine? Or it needs it? I mean, the training can we do the training without the machine? This specific machine that we are selling. We realize that no, if a customer comes with their own machine, similar machine, then we can actually provide the training. So if that is the case, we are talking about them, they're not really dependent on each other. One can still function without the other, and then the other can still also function with, like it says here, the customer can purchase the machine without the training services. So there's no high dependence, and also there's no interrelation between the two. Okay, so then you conclude then that the criteria is met. It means now it's not it's separately identifiable because of the three. None was applicable on the three, so it's separately identifiable, and also it can benefit the customer on its own. So what does that mean? It therefore means that it's distinct. Okay. So if it's distinct, then we can conclude that it's a separate performance application. I hope you were noting my mini conclusions before the final conclusion. The final conclusion to say it's a separate performance application, it's after I've concluded that it's distinct. Then that's how I'm scoring my marks. And look at how I was building my argument. So you build the argument, and I normally say on building the argument, you do not start with the end in mind. You do not start with, okay, this now looks like it's going to be a separate performance application, and you ignore any other factor that can suggest that it's not. So you need to be open-minded. You need to be reading the question and say, okay, but wait, this information is telling me that it could be, it could not be a separate performance application. But then you go back to another information that suggests that it could be a separate performance application. So you do that, you argue, and then at the end, you come up with the conclusion. So please just be careful of that, because then you are denying yourself the opportunity to be scoring those marks on the things that you are not discussing, just because you feel like they're gonna make you to take a different direction. Very, very important. Okay, now we look at the second promise. Okay, it doesn't really matter which one you started with. Someone can start with a training or a warranty. It doesn't really matter. So now let's move into the warranty one. Okay. So if you look at the warranty, we did say that they cannot be sold separately, and then we couldn't prove that it's providing an additional service in addition to making sure that it complies with the agreed upon specification. So if that's the case, we're saying we treat it in terms of IS-37, like a provision. Okay, so if it was, however, it could be sold separately, then that's where now we look at those other factors, because then it gives us an option to say it can be a separate performance application. So here, find out it's not giving us anything in addition, therefore it means that it's not a separate performance application. It would be treated in terms of the IS-37. Okay, so it means that whatever the amount that would be attributable to selling the warranty, it's going to form part of the sale of or it's going to be recognized as part of the sale of the machine. So it's not separate. So so it means here you've bought two performance applications, the sale of the machine and then the training services. But the warranty is not a separate performance application. Okay, so other factors that could maybe be an indication that it's an additional service, it's when it's not within the normal warranty period, but we are told that the warranty period was 12 months. Okay, then that's the normal warranty period. So it's really not giving us anything in addition to say maybe this is us selling this warranty. It's not giving us that. Therefore, it would not be a separate performance application. Then you conclude about that. Again, the logical flow. You need to be flowing. You introduce your argument, you argue, and then you conclude. If you've not concluded, it simply means that you are not done with the question, or you've not answered the question. Okay, so I know that we're running out of time. I said 1 hour, 30 minutes. Let's just look at this one again, which is the appropriate accounting treatment of the right of return. I did again during if you do most of your analysis during your reading time, you will have nice times here answering your questions, because you know exactly what you need to be discussing. So what happens here again is that we've identified the IFRS 15 paragraph B21 up to 23 to say this is what we're going to be using as our relevant theory. Okay, How are we supposed to account for this? We spoke about the fact that you have to recognize the revenue only to the extent that you're expecting that you will get the money. Then the remainder would be the refund liability. Then the other part would be the right of return. Okay, we did speak about that. So how this question was then laid out was to say, okay, we're going to look at revenue to say this is how revenue will be accounted for, and then we move on to right of return, and then we move on to refund liability. Okay, so that's also what they did in this question. Okay, if you look at this, they talk about step 3 up until step 5. So the step 5 requires that you recognize the revenue. Okay, but when do you recognize the revenue? You recognize the revenue when the performance obligation has been satisfied. When is the performance obligation satisfied? Now that's step 4. It's when the delivery has actually taken place. The information in the question did tell us about that. Okay, and then the determination of the transaction price is actually, okay, now that the satisfaction has happened, but what am I recognizing now as the revenue? It's based on the transaction price. Okay, so remember when we're saying to the extent is 55 pairs, because the 6% is not the extent that we will be getting. It will not. It's not. We are not sitting at this stage until it lapses. If that 15 days lapses, then we are sitting. That there's nothing that we're going to be paying any other person. So that is the logic behind this. Okay. Here it talks about that measurement to say the price varies. It varies because there is that percentage that could still go to our customers. So we can't really recognize the full amount. Okay. So it includes the variable component. That's now the determination of the transaction price. Okay. Then the numbers, because they're required specified that you need to show your calculations. I spoke about these numbers as we were still discussing the question. To say it's going to be 53,200 because you're basing it on the 55. That's the revenue. Then the refund liability would be the difference, which is the 5.7, which I also alluded to. Okay, so as you are discussing, then you are also bringing in the calculations there. And then there's also the refund, the right of return asset. This part now will be based on the cost price. Remember, I said it's only going to be the cost price or the carrying amount of the inventory that was sold, because we were told that the cost of collecting is actually immaterial. So therefore, we'll treat them as 0. We'll just focus on the 500 being the cost price. So that is the way in which we have to deal with this. You talk about the asset to say this is the asset that we're going to recognize, and if the question had gone on to say, okay, what happens now in March? If in March we realize that people actually come and return the shoes, when they return the shoes, what happens to the asset, the right to recover the asset? And then what happens to when they don't recover, when we don't return, and then the right lapses after 15 days, what happens to the asset as well? So those are the things that we need to look at, because now it means that you can actually recognize the cost of sales. Remember, I said if it lapses, you can recognize the revenue. But now, if it lapses again on the other side of the cost of sales, it means that you can actually now recognize the cost of sales for the 3,000 that you never recognized, but you recognize the right of return. So you reverse the right of return and you recognize the cost of sale. So that's the very important part that I wanted to bring in there. From my side, if there are any questions, I think Carmen is dealing with the questions. But for me, that would be it. And I would like to wish you everything of the best for your upcoming exams under not so normal conditions, but just be prepared mentally. And I think that you guys have been studying, you've been consistent in your study. you will be rewarded for the efforts that you've been putting. So good luck, and yeah, all the best. Okay, I'm just looking at the questions now.